What's up, everybody? It's your boy Sham, also known as the BJJ Lender, and today we're talking about freedom. Freedom from the IRS, freedom from the banks, freedom from having to ask anyone for permission to move your own money. This episode is called Be Your Own Bank, and we're diving deep into the infinite banking concept powered by permanent life insurance. Now, I know you probably heard life insurance and thought, this ain't for me. But trust me, bro, if you stay tuned, you'll see why this is one of the most powerful wealth tools that exist. One the wealthy have been using for decades. This is about taking control of the flow of your money. And today I'm gonna show you how to stop working for your money and start making your money work for you. Now, that's out of the way, hit my damn intro. Let's start with the basics. There are two types of life insurance, y'all. Term and permanent. Term insurance is like renting an apartment. You pay your rent every month, you get a place to stay, but when your lease ends, you walk away with nothing. You're just paying for temporary protection. Permanent insurance, on the other hand, is ownership. It's like buying the property. You're building equity, except here it's called cash value. That cash value grows tax-deferred, and when designed right, you can access it tax-free while you're still alive. That's the secret sauce of infinite banking. It's not about dying rich, it's about living free. Now, inside the permanent insurance world, there are two main styles of play: whole life and index universal life, or IUL. Whole life is like your financial tank, slow, steady, reliable. Guaranteed growth, guaranteed death benefit, and usually dividends from a mutual insurance company. It's not flashy, but it's consistent. Perfect for people who want guaranteed legacy and stable growth. Now, the IUL, that's a cash flow machine. It's linked to a market index like the S&P 500. But here's the key. Your money is not invested directly into the market. Instead, your cash value gets credited based on how the index performs, with a cap on the upside and a floor that protects you from losses. That means you get to enjoy the market gains to a limit, but when the market drops, you don't lose a dollar of your principal. Whole life is about stability and legacy. IUL is about growth and flexibility. Different weapons, same dojo. Now, let's talk about where people mess this up, Oos. Most people buy life insurance like it's a product, not a strategy. They focus on the death benefit, not the living benefit. But here's the truth. We're alive. The death benefit doesn't help us. The cash inside the policy does. That's why at Fortitude, we structure our clients' policies for cash value, not commissions. We call this overfunding, not overinsuring. When we build a Fortitude-style policy, we keep the death benefit as low as legally possible and the premium as high as strategically possible. That means more of your money goes to cash value and less goes to pure insurance costs. We also make sure you don't trip the IRS's MEC line. That's the 7702A rule. Because if you overfund too fast, it becomes a modified endowment contract. And that changes your tax benefits. We funded strong in the early years, the first 5 to 7, to get the compounding started, because those early dollars are just like early jiu-jitsu reps. They build a foundation for everything else. For whole life policies, we use paid up additions to stuff more cash in without overpaying for death benefit. For IULs, we start with option B, which increases the death benefit as cash value grows so we can keep overfunding safely. Then later, we switch to option A to lock in efficiency. Every piece has a purpose. Less fluff, less waste, cash first, commissions last. That's Fortitude's way. All right, here's where the game changes. Once your cash value is built, you can borrow against it through what's called a policy loan. You're not withdrawing your money. Your cash value stays inside the policy, still compounding. Instead, the insurance company lends you their money using your cash value as collateral. No credit check, no underwriting, no waiting weeks for approval. It's your money, your rules. You can use those funds for down payments, renovations, business opportunities, or investments, whatever you want. It's your money after all. And here's where the math gets you crazy. The loan rate from the insurance company is usually around 4 to 6%. Compare that to a traditional bank loan at 8 to 10%, or even higher if you're doing hard money or private lending. That difference, y'all, that spread, is your arbitrage. You're borrowing at your rate, not theirs. And while that borrowed money is out there working in your next deal, your cash value is still earning interest inside the policy. You're making money in two places at once. That's the BJJ double tap. Choking from both sides. Now, if you never repay the loan, that's fine. The balance just gets deducted from the death benefit when you pass. But smart investors pay themselves back with interest because they're building up their own bank. Again, that's the fortitude way. I know what you're thinking. Sham, this sounds too good to be true. How's this even legal? Well, let me introduce you to the tax code TRINITY, the sections of the IRS code that makes all this possible. Section 7702 defines what qualifies as life insurance. If your policy meets those rules, your cash value grows tax deferred. Section 7702A sets the limits for how much you can fund before it becomes a MEC. That's why we design carefully, so you can stuff cash in while you're staying compliant. Section 72E says that as long as your policy stays a non-MEC, you can withdraw your basis tax-free and access earnings through policy loans, also tax-free while the policy is active. And finally, Section 101A. That's the one that makes your death benefit income tax-free to your beneficiaries. Put all that together. 7702 builds the chassis, 7702A keeps you between the guardrails, 72E lets you access cash tax-free, 101A crowns your heirs with the tax-free legacy. That's how you legally play offense with the tax code, not against it. Let's put it all together. Say you built up $200,000 in your cash value in your IUL. You find a duplex for $600,000 and you need $120,000 for the down payment. You call your policy, not the bank. You take a policy loan for 120 G's. You close the deal in 10 days. Your cash value still compounding inside the policy, untouched. Now, your rental income covers the policy loan payments. And when you pay it back, that cash value goes right back into your private bank, ready for the next move. That's not theory, y'all. That's the game the wealthy have been playing for years. Now, just like BJJ, technique matters. You can't muscle your way through this strategy. Keep your policy in force, stay under MEC, and review it every year with your advisor. Ideally, with Team Fortitude, to make sure it's still performing, that your loans are balanced, and that your strategy still aligns with your goals. This ain't a set it and forget it policy. It's a financial weapon that needs maintenance. But when used right, it's one of the most powerful tools in existence. This right here, this is how you break the chains from the IRS, from the banks, from the system that wants you trapped in debt and paying interest to everyone but yourself. When you master internet banking, y'all, you take that power back. You borrow at your rate. You pay yourself interest. You control your liquidity. And your legacy stays protected and tax-free under your name. As always, if you're earning $300,000 or more and you're ready to build your own private banking system, tap in with me and Team Fortitude. We'll design your policy for cash value, not commissions, and help you build real financial freedom. Like, follow, subscribe, YouTube, TikTok, Instagram, at the BJJ Lender, and share this episode with a business partner or investor who still thinks the banks run the show. Because over here, we don't just roll, y'all, we strategize. Until next time, y'all, it's your boy Sham, also known as the BJJ Lender. Us.